In this video, I cover the one growth ETF that I would hold forever if I had to choose just one single ETF. Here's a crazy stat. Just 1 year ago, some growth stocks were up nearly 900%, while others lost more than 80% of their value in the exact same time frame. That's the brutal reality of chasing individual growth stocks. You can make life-changing money or lose it overnight. And that's exactly why smart investors don't gamble on single stocks. Instead, they invest in growth ETFs, funds that hold dozens or even hundreds of high potential companies all at once. By doing that, you're stacking the odds in your favor, lowering risk, and still capturing the upside of innovation. In this video, I'll break down some of the best growth ETFs available today, explain how they work, and reveal the one ETF I would personally choose if I could only hold one for the rest of my life. Make sure to stick around until the end. I'll share the key mistakes most beginners make when investing in ETFs and how you can avoid them. Before we dive in, hit that like button, subscribe to the channel, and turn on notifications. If you're someone who wants to take control of your finances and build wealth step by step, you're in the right place. My name is Chris, and let's jump in. Growth investing is all about owning companies that are expected to grow faster than the market average. These are usually businesses in technology, healthcare, or innovative industries that are expanding rapidly. Think things like artificial intelligence. Now here's the challenge. Picking the right growth stock is incredibly difficult. For every winner that goes up 500%, there's another one that collapses. And unless you're willing to spend hours researching financial statements, earning reports, and market conditions, it's almost impossible to consistently pick the winners. This is where growth ETFs come in. An ETF, short for exchange traded fund, is like a basket of stocks. Instead of buying one company, you buy shares in the entire basket. That way, even if one company fails, the others can balance it out. So rather than trying to guess the next Amazon or Nvidia, you're betting on the overall trend of innovation and growth. Let's start with the sector everyone is talking about right now, which is artificial intelligence. AI is already transforming industries from healthcare to finance, and trillions of dollars are being invested in new infrastructure, especially semiconductors and cloud computing. The first ETF worth noting is the Global X Artificial Intelligence and Technology ETF. Ticker symbol is AIQ. This fund tracks companies directly tied to AI developments and data processing. It's been around since 2018, has more than 80 holdings, and includes names like Nvidia, Meta, and Amazon. The fund's annualized return since inception has averaged in the mid-teens, which is impressive given its relatively short history. The second big player in this space is the Global X Robotics and Artificial Intelligence ETF. Ticker symbol is BOTZ. Unlike AIQ, which leans heavily towards software and big tech, BOTZ focuses more on robotics, automation, and AI hardware. Think industrial robotics, autonomous vehicles, and medical robots. This fund has been around since 2016 and includes companies like ABB, Intuitive Surgical, and of course, Nvidia. Its long-term average return has been in the low double digits, and many analysts expect that to improve as robotics adoption accelerates over the next decade. So if you're looking for exposure to AI, both AIQ and BOTZ provide solid options. The main difference is whether you want more software-heavy exposure or more robotics and hardware exposure. Every single AI breakthrough, every new iPhone, every electric car, all of it runs on semiconductors. Without chips, none of this innovation is possible. That's why semiconductor ETFs are some of the strongest growth plays on the market right now. The most popular is the VanEck Semiconductor ETF. Ticker symbol is SMH. It tracks 25 of the largest semiconductor companies globally. Its top holdings include Nvidia, Taiwan Semiconductor, Broadcom, and AMD. Over the past decade, SMH has averaged returns well above 20% annually. That's an incredible long-term track record. But SMH isn't the only option. There's also the Invesco PHLX Semiconductor ETF. Ticker is SOXQ. This one tracks 30 semiconductor companies and offers nearly the same exposure as SMH, but with a lower expense ratio. That means it costs less to own each year. Its performance has also been in the mid-20s annually, which is very close to SMH. If you want exposure to the future of technology, semiconductors are almost unavoidable, and either SMH or SOXQ can give you that exposure. So let's zoom out. Specialized ETFs like AI or semiconductors can deliver massive returns, but they also carry more risk because they're concentrated in one sector. If If that sector slows down, your investments take a hit. That's where broad growth ETFs come in. These funds spread their investments across multiple industries, giving you more balance and stability. One of the most well-known is the invest code QQQ. But here's a tip. The cheaper version, called QQQM, gives you the exact same exposure with slightly lower fees. It holds over 100 of the largest non-financial companies in the NASDAQ, including Microsoft, Apple, Amazon, Nvidia, and Alphabet. This index has averaged around 18% annually. Another great option is the Vanguard Growth ETF, ticker is VUG. This fund tracks large cap US companies with nearly 200 holdings. Its top names look very familiar: Microsoft, Apple, Nvidia, Google, Tesla. Vanguard is known for keeping costs low, and this ETF is no exception, with one of the lowest expense ratios in the industry. Historically, it's delivered strong double-digit returns over the past decade. The third broad option is the Schwab US Large Cap Growth ETF, ticker is SCHG. Similar story here, over 250 holdings, low fees, and exposure to the biggest names in tech and healthcare. This one has been around since 2009 and has averaged around 16% annually over the past decade. So if you want diversification with strong growth, QQQM, VUG, and SCHG are 3 ETFs worth serious consideration. Now let's take a slightly different approach. Instead of focusing on all growth stocks in the market, some ETFs focus only on the growth companies inside the S&P 500. The Vanguard S&P 500 Growth ETF, ticker is VOOG, is one example. It invests only in the faster growing half of the S&P 500. That means you're still getting big names like Microsoft, Apple, and Amazon, but without the slower growth companies in the index. Another option is the SPDR portfolio, S&P 500 Growth ETF, ticker is SPYG. It's very similar to VOOG, but with a lower share price, which can make it more approachable for newer investors. Both funds have delivered solid long-term results, averaging around 14 to 15% per year over the past decade. These are great for investors who want to stick with large, established companies, but still tilt toward growth. So here's the big question. If I had to pick just one growth ETF to hold forever, which would it be? While AI and semiconductors are exciting, and tech ETFs have delivered massive returns, the reality is that concentrating in one sector is risky. A single downturn could cut your portfolio in half. That's why my top choice would be a broad growth ETF. Among QQQM, VUG, and SCHG, you really can't go wrong. But if I had to choose one, it would be QQQM. This is because it gives you exposure to the 100 largest non-financial companies on the NASDAQ. These are the innovators, the companies leading the charge in cloud computing, e-commerce, artificial intelligence, and beyond. The historical performance speaks for itself, and the lower expense ratio compared to QQQ make it the smarter choice. So if I had to own one growth ETF for the rest of my life, it would be QQQM. Now, you don't have to stop at just one. In fact, most investors are better off holding a mix of ETFs for diversification. A simple approach could be to own 3 to 5 ETFs total. For example, one broad growth ETF, one total market ETF, and maybe one sector-specific ETF like semiconductors or AI. That way, you're capturing innovation, but also protecting yourself with broad coverage. Here's something you can do today. If you're brand new to ETFs, start by comparing 2 or 3 of the ones I just mentioned. Look up their top holdings, their expense ratios, and long-term performance. Pick the one that matches your goals and your risk tolerance. Let's quickly cover the mistakes you should avoid with growth ETFs. First, don't overload your portfolio with too many similar ETFs. Second is don't chase performance based on only what's hot this year. Sectors move in cycles, and what's up 30% in one year could be flat the next. That's why diversification matters. And third, remember that growth ETFs can still be volatile. Even broad funds like QQQM can swing up or down by 20% in a year. So make sure you're investing with a long-term mindset, at least 5 to 10 years. To recap, growth ETFs are one of the smartest ways to invest in innovation without taking on the massive risks of picking individual stocks. Whether it's AI, semiconductors, or broad growth funds, there are plenty of options available. But if I had to pick just one, my choice is QQQM for its balance of diversification, performance, and low cost. What about you? If you could only own one ETF forever, which one would you choose? Let me know in the comments. I'd love to hear your take, and I'm sure others would too. Don't forget to like and subscribe, turn on notifications so you don't miss future updates. As always, thanks so much for watching, and I'll see you guys in the next one.